Ora, boa tarde a todos. Bem-vindos a mais uma sessão do Chicago Trading Sessions. Eu agradeço desde já a vossa participação. O meu nome é Ricardo Contins, sou gestor de produto no BiG. Iremos dentro de alguns instantes dar início a esta sessão. Apenas introduzo aqui um pequeno pré-disclaimer referindo que a sessão será em inglês, tal como a sessão referente ao ouro. E ao dia de hoje iremos ter aqui o tema do petróleo, ou seja, a negociação de petróleo, aqui ter aqui uma perspectiva, vamos dizer assim, do petróleo para os próximos meses. Eu iria aproveitar, ainda antes de darmos aqui efetivamente início e passarmos aqui para os temas do webinar, se me podem confirmar na linha de chat que nos conseguem ouvir, que estão a conseguir ver o ecrã do apresentador, eu agradecia que me dessem essa confirmação. Perfeito. Eu agradeço então que a confirmação em causa. Eu vou-vos pedir para dar aqui 2 minutos. Voltaremos em inglês, só para permitir que todos consigam aqui juntar efetivamente. E dentro de aproximadamente 2 minutos daremos início em inglês a esta sessão do Chicago Trading Sessions. Mais uma vez, obrigado pela vossa participação. Voltamos desde já, alguns instantes. So, good afternoon to all. Welcome to another series of Chicago Trading Sessions with Eric Norland. My name is Ricardo Contins. I am product manager on BiG on the trading platform's team. We will begin this webinar of negotiation of crude oil and the perspectives of crude as a principal theme of this webinar. We will take a special invitation of Eric Norland, senior economist of CME Group, and we will talk about the energy markets and the economic drivers and rise factors. So this session will be with Eric Norland in some minutes. Could you please confirm me that everything is well so we could begin? Any doubts that you have, you could use the chat available on the platform for even every one of you, and any questions that you have, I will be asking Norland about anything that you need. I don't know if you could hear me, Eric.
Yes, I can. Can you hear me?
Yes, perfect. We already see your screen, so everything looks fine.
All right, great. So we're ready to go?
Okay, so I gave you the word. You could have the stage from now.
Okay, thank you so much. And thank you for having me back. It's been such a pleasure to speak with you. I wish, of course, we could be doing this in Lisbon or Porto or some other beautiful part of Portugal. But nevertheless, we will have to settle it for doing it remotely on GoToWebinar for now. Before I begin, I am required by CME Group to show you both the short version of our disclaimer, as well as the longer and more detailed version of our disclaimers, which essentially say that because CME Group is an exchange operator and not a broker dealer or an investment bank, we are unable to give you any financial advice. So no financial advice is given or intended. But I thought we would talk about the petrol markets over a very, very long period of time, and talk about all different aspects of them that can influence their trading environment, including the demand factors, what drives petrol demand, inventories, supply factors, what drives production levels around the world and what to expect from those production levels over time. And some of the things I'll bring up, will be fairly standard things like measuring inventories and the best way of looking at them. But some of them I think will be very weird and very creative, very strange things that happen sometimes in the petrol markets. But as you can see, petrol has a long, long price history that was very boring until 1973. From sort of the late 1940s until the early 1970s, petrol prices barely moved. Then the market suddenly became very exciting in 1973 with the first oil embargo, which caused the price of petrol to go from about $3 to about $12 per barrel. Then it kind of slowly drifted higher in the late 70s up to about $18 a barrel, then suddenly rose to 40. It was really those twin oil crises in the late 1970s or in the mid to late 1970s that inspired the creation of a futures market on petrol. The oldest futures market on petrol is our heating oil contract, which we now call ultra low sulfur diesel. That came about in 1978. But by 1983, we had launched West Texas Intermediate Crude Oil Futures, which are now the main benchmark for traders in the United States, and are seen as a leading benchmark by people all over the world. And around that same time, we also launched futures on gasoline, and there's a number of smaller futures. We won't really talk about too much, but we also will discuss the natural gas future, which has existed since 1990. So petrol prices, you can see, have been on an absolutely wild ride over the course of the last 40 years, and in particular over the course of the last 20 years, going from as low as negative levels briefly last year to as high as $147 per barrel back in 2008. Now, last time we spoke, we talked about gold markets. I do like looking at investments, comparing one thing to another. So I thought we would just mention gold in the context of crude oil very briefly, to sort of transition from our discussion of gold a couple of weeks ago to our discussion of crude oil today. The gold market is in a very different state right now than crude oil. Over much of recent history, going back to the 1980s, gold and oil prices moved more or less in tandem with one another. There were periods, especially after the Iraq War, when oil prices rose much more quickly than gold. But recently we've been in a period in which gold has been a much stronger investment than oil. But the ratio between gold and oil can have really, really strong movements. So, generally speaking, when there's a lot of inflation, you may see all commodity prices rise together. So gold and oil prices may go up in tandem. But you can have very specific periods of oil crisis in which oil prices dramatically outperform gold. And you can have other periods of, hoarding of, precious metals and very weak demand for transportation fuel, which is where we've been for perhaps the last 6 years or so. But I won't talk about gold too much today. We can also, of course, compare equities to crude oil, or crude oil to equities. This is how much crude oil you can buy per unit of the S&P 500, for example. You can see that here too you can have really strong trends in the ratio between the stock market and crude oil over time. So it can be a very interesting thing to compare crude oil to as well. But that's all I'm going to talk about in terms of crude oil versus other assets. So at least until the end of the presentation. So for the moment, I thought we would first of all talk about the demand drivers for crude oil. Crude oil, as I'm sure you all know, is the world's primary transportation fuel, or the source, I should say, for the world's transportation fuels, whether that's diesel fuel, gasoline, jet kerosene, or the fuel used in most ships, or most ocean-going vessels. And you can see in particular the price of oil in the last, say, 15 or 16 months has been following the condition of air travel in the United States very, very closely. The air travel data is interesting because you can get daily updates from the Transportation Security Administration, or the TSA, that show you how what the percentage of passengers is versus the same period in 2019. So oil prices, of course, crashed along with air travel in this March, April, May last year, and then has slowly recovered along with the demand for passenger travel in the US over the course of the past 12 or 13 months. So the outlook for this is still a little bit uncertain. The US market is different than most. The United States domestic market is one of 3 domestic markets in the world, along with China and Australia. And I should probably add Canada too, where there's a lot of domestic travel internally by airplane. There's a few other countries where that's the case, like Brazil or Mexico. But for the most part, international travel remains very seriously disrupted. So domestic travel in many countries has rebounded to about 75% or so of where it was previously. But international travel still remains down by about 70%. It's still, as I'm sure you know, very difficult to cross international borders. That was highlighted recently here in the United Kingdom when we opened everything up, except that you can't fly to France right next door without quarantining. Another way of looking at petrol is looking at it as a calendar spread. So actually I'm going to advance one slide and then come back. So WTI, or West Texas Intermediate, or really any benchmark, whether it's Brent or whether it is gasoline or ultra low sulfur diesel, they all have a curve. So there's many different contracts. The contracts in all of these markets are spaced out monthly. Typically, most of the volume is in the nearby months. But if you look further out, there's typically pretty good volume in the December contracts in years further out. At the moment, the crude oil curve is in what we call backwardation, which is to say that the short-term price of oil, say for delivery in September 2021, is much, much higher than the long-term price of oil for delivery in, say, 2022 or 2023. So the market has taken this view that the rise in oil prices is kind of temporary, and it will settle to a long-term equilibrium price of around $57 per barrel on WTI, and maybe slightly higher than on Brent, maybe more like 60-some dollars on Brent. Whether or not that view turns out to be correct or not is another matter. I view this as being kind of like the center of a probability distribution, but the probability distribution is very, very wide. So this is not a prediction of what will happen. It's sort of like a maximum likelihood of what will happen. But what is interesting though is when you graph the difference between, say, the September 2021 and September 2022 contracts. It's the difference between the first contract and the 12th contract over time. And you compare it to the price, you can see that since about 2007, there's been this strong sort of inverse relationship between the level of prices and the shape of the curve. So when prices are high, compared to where they have been recently, typically the curve is in backwardation. People tend to think, well, prices are exceptionally high, so therefore they're likely to fall in the future. And likewise, when prices are very low, like they were in, say, 2009 or in 2015 or in 2020, people tend to expect that prices will rebound. So the market has had this view for the past 15 years or so, that the oil market is mean reverting, that if prices go up too much in the short term, they will wind up correcting back downward in the long term. But in the oil market though, like any commodity market, when the curve is inverted, so the near-term prices are higher than the long-term prices, that means there is a positive carry, which is to say that Imagine that the price doesn't go back down to $58 per barrel, but stays at $68 per barrel going forward. As you roll down the curve, you make money simply by being long. By contrast, if the curve were shaped the other way and it were going positive and what we call contango, it would have a negative carry. So you would tend to lose money as you rolled the contracts forward. Assuming prices didn't follow what the curve was said it was going to do. One of the really important factors to look at to determine the health of the oil market is the level of inventories. Inventory data is released every week in the United States. It's more difficult to come by for the rest of the world, but there are private services where you can pay to get satellite data that track the amount of oil being stored in tanks in different parts of the world, and also the amount of oil being stored on oil tankers offshore. But the US data is still useful, even though it only covers one country. The US is a major oil consumer. The US consumes about 15 to 20% of global petrol each year. And what's happening with US inventories is often indicative of what's happening with inventories elsewhere in the world. US inventories have been at pretty high levels since 2015, and oil markets have been pretty challenged since then, with prices somewhat lower than they had been. But it's worth pointing out that the year-on-year change in US inventories for crude oil is down. Inventories are about 17% lower now than they were at this point last year. So it's a sign that the market is clearing. Essentially, inventories are the difference between supply and demand. So essentially supply minus demand is equal to the level of inventories. But inventories of crude oil are only part of a bigger picture. To take a more complete or comprehensive view, you should also take a look at the level of inventories in gasoline and ultra-low sulfur diesel, which are also published on a weekly basis by the US Department of Energy, or actually one of its sub-agencies called the Energy Information Administration, or EIA. These data are available on Bloomberg. You can also get them from the EIA website as well. And you can get a very long time series, which can be useful if you're trying to put it into your models to describe how the crude oil market is behaving. Another way of looking at it from a seasonal perspective is just to look at the level of inventories so far this year versus where it was in previous years. And the reason for looking at it this way is that oil inventories tend to have a strong seasonal pattern. In a typical year, inventories increase during the first 5 or 6 months of the year. So the oil companies are busy storing oil in January, February, March, April, and May that they believe will be used over the course of the summer. Because people tend to drive more during the summer as they go on vacation. Air travel also tends to increase in the second and third quarters, particularly in the third quarter, summer vacation season. People are more likely to get on planes and fly places to go on vacation. So typically inventories fall during that time of the year and then start rebuilding around October and November, but then typically fall a little bit around Christmas and New Year's when people also travel a great deal. So far this year, inventories have come down to levels that are not only below where they were in 2020, but they're also below where they were at this time in 2017 and 2019. They're still a little bit above 2018. You could argue that this is a little bit distorted because the level of consumption is not as high now as it was before either, because the pandemic is ongoing and so people are still not commuting to work as they were before. And even though Americans have begun to drive a great deal on vacation, they're not going on vacation quite to the same extent as they were, say, 2 summers ago. And you see that obviously in the air travel numbers, which are still down by 25%. If you look at the product inventories, they also follow their own seasonal pattern. You tend to see a buildup in inventories between November and May, and a drawdown in inventories between May and maybe October. So far this year, gasoline inventories and ultra-low sulfur diesel, formerly known as heating oil, their inventories are pretty much in line with where they were the 3 years before the pandemic began in 2020. In terms of production, there are really two swing producers in the world that really determine where the supply of oil is going. So one is OPEC, which includes, of course, Saudi Arabia, Iran, Iraq, and many other Middle Eastern countries, along with a few countries outside of the Middle East, like Venezuela. But for the most part, these are Middle Eastern countries. The organization, of course, is dominated by Saudi Arabia. And all of these countries cut back production quite substantially as a result of the pandemic. In the very early stages of the pandemic, there was a sort of oil war between Saudi Arabia and Russia, who thought this was be an opportunity to grab market share. That explains why prices crashed to such an extent last year. It was not only that the pandemic was shutting down demand worldwide. In addition to that, there was a competition between Saudi Arabia and Russia to take as much market share as possible. But when prices crashed to negative levels on our exchange very briefly for one day, and they went down to very low levels on other benchmarks, Saudi Arabia and Russia got serious and decided to scale back their production. So now people talk a lot about OPEC plus Russia as being sort of one entity, because the Russians, even though they're not technically a part of OPEC, for the past 6 years or so, they have often coordinated their activities with OPEC, but not always. The other set of swing producers is in North America, and particularly in the United States. If you look at world production since 2004, and you add up Saudi Arabia all the way through the former Soviet Union, world production barely grew from 2004 to 2019. It was pretty much unchanged. It was only in North America that production really started to grow in a very substantial way. And that's part of what made West Texas Intermediate crude oil such an important benchmark, not just for the United States and Canada, but worldwide. Because a lot of the price discovery and price action was taking place in the United States and Canada because of this tremendous growth in North American production. It happened very much as a result of one thing, which was hydraulic fracturing or fracking. So crude oil production in the United States went from about 5 million barrels per day in 2007 and 2008, all the way up to 13 million, which was a really, really enormous increase. Now with the pandemic, the crash in oil prices did cause US producers to take some of their production offline. So that came down to around 11 million, but it is starting to rise once again. It's starting to head back up towards 11.5 million, maybe getting sometime later this year to 12 million barrels per day. US production is very different than OPEC. OPEC essentially meets in Vienna. They have 2 big meetings per year, and they have a number of smaller meetings. But OPEC essentially makes decisions for state-run oil companies, and it's very political in nature. The US producers are the complete opposite. They have very little political input, but they tend to make purely economic decisions about where to take petrol and where petrol prices should be going. And whether or not petrol prices are high enough for them to justify continuing to produce it or not. And so it was really this technological revolution of shale that caused oil production in the US to begin to rise. But when you look at this US oil production number here on this chart, this includes all of the production, including production coming from non-shale sources like in the Gulf of Mexico, where there has been offshore drilling for decades, as well as in Alaska, which produces a couple million barrels of oil and has done so for many, many years. But when it comes to fracking in the United States, it really comes down to 7 different regions of the country. And the most important one is this one colored brown in the western part of Texas, called the Permian. And the Permian is responsible for about 4.5 million barrels per day of US production. It has shown much stronger and much more consistent growth than have the other fracking regions. The other two most important ones are Eagle Ford, which is also in Texas, and the Bakken region, which is further north up near the Canadian border in North Dakota and in Montana. And there are a few smaller regions like Anadarko and Niobrara that are also oil producing regions. Anadarko is in western Oklahoma, and Niobrara is mainly in Colorado and Wyoming, and a little bit in Nebraska. But essentially, the reason why Permian is the major center is not because the oil wells are better. The oil wells in Permian are not much different than they are elsewhere. The reason why is Permian is very well connected by pipeline to both Cushing, Oklahoma, which is the point at which West Texas Intermediate crude oil is priced, as well as to Houston, Texas, which is the main port in the United States from which oil is exported to the rest of the world. So there are pipelines from the Permian to Houston and from Permian to Cushing. And it costs about $2 per barrel to send oil through those pipelines. By contrast, up in the Bakken region, for example, in that part of the world, in that part of the country rather, it takes about $9 or $12 to ship oil out of there or out of Eagle Ford. It has to be sent by truck or by train, which is much, much more expensive. So you've not seen so much production growth in those regions because they're not as well connected by pipelines. Lastly, there's these two other regions, Appalachia and Haynesville. They are not mainly oil producers, but there is fracking, but the fracking creates natural gas, which we'll talk about briefly in a minute. So when it comes to oil, essentially the level of oil production is described by this equation. Oil production is equal to the number of rigs drilling for oil multiplied by the productivity per rig. And so the rig counts you can see are actually very, very low. There's very little oil exploration going on in the United States. It used to be, that maybe 10 years ago, there were thousands of rigs drilling for oil, trying to figure out where it was. Now you're down to a few hundred rigs in the entire country that produce all of this oil. And so the reason why we've been able to increase production in the United States is because we have had a productivity revolution. The amount of oil being produced per rig has increased enormously as a result of technological improvements that allow for sideways drilling. So you don't have to drill just straight downward. You can drill first downward and then go sideways or in a variety of different directions to unlock a whole bunch of different oil and then bring it out all at once. And so it's really this productivity revolution that's caused oil production to increase so much. The same thing is true for shale. There's shale gas, I should say. Shale gas production is also same equation, rig counts times productivity per rig. But in shale, the gas is coming from different regions. It's coming mainly from Appalachia and from Haynesville. But the US has sort of transformed itself in the last decade or so into a major producer of natural gas. And in particular, in the last 5 years, has begun to export natural gas to the rest of the world, including China, Latin America, Europe. Shipments are going really all over from the United States to all different parts of the world. And so liquefied natural gas exports have become a major, major source of export revenue for the US firms. And those are coming mainly from the Haynesville and the Appalachia region. But I don't want to focus too much on natural gas. So let's go back to oil. One of the things that's very interesting in oil markets is you can see that there is this relationship between the price of oil and the number of operating rigs. So typically what happens is when the price of oil crashes, sometime later on, usually with a few months delay, the oil producers start taking their rigs offline because they are no longer profitable to operate. By contrast, when oil prices begin to rise, you usually see an increase in the number of operating rigs. But sometimes the number of operating rigs doesn't increase as quickly as you might expect. And that's been particularly the case in recent years outside of the Permian region. So when you look at Anadarko, Bakken, Eagle Ford, and Niobrara, their rig count has increased very, very slowly over the last few years. And I think that's because of the lack of connectivity to pipelines. In addition to that, you also have some more recent political developments in the United States as well. Under President Obama and under President Trump, the United States allowed drilling to happen both on private and on government or federal lands. One of Joe Biden's first actions as president was to make a ban to forbid any new drilling on federal lands. So existing drilling that already took place can continue to produce oil, but there can't be any new exploration. And that's going to lock a certain amount of petrol in the ground, but it's not a huge deal. Basically, 90% of the petrol produced in the United States is produced on private land that are not impacted by those regulations, and only about 10% is produced on public land. Also in the past, there's been a relationship between the bond market and oil. When I say the bond market, I do not mean the US Treasury market. What I mean is corporate bonds that are issued by energy companies. So in other words, the option adjusted spread of high yield bonds issued by energy producing companies. So sometimes when there is a tight credit conditions and the market for credit seizes up, that cuts off the supply of capital to the oil industry, which in turn makes it so that they can't drill anymore. But one reason I think to be very optimistic about the amount of drilling is that because of the Federal Reserve's quantitative easing, the cost of capital for the oil industry currently is extremely low. So they get very, very cheap loans if they want to go and drill for oil. So I think that that's going to be a source of potential growth for oil drilling going forward. The crude oil market also has tremendous impacts on other assets around the world. So if you are a currency trader, and in particular, if you're invested in currencies like the Canadian dollar or the Russian ruble, those currencies often tend to follow what's happening in the crude oil market. The Russian ruble has diverged from crude oil in the past 12 months. I think that's because Russia had to scale back its production after its oil war with Saudi Arabia. And also Russia has been hit exceptionally hard by COVID. According to the Russian government, officially there are about 100 or so thousand people dead as a result of the pandemic. However, Russia has had an excess death rate of around 450,000 people, which suggests that the government there has been undercounting the number of people who've really died of COVID. So the Russian economy, I think, has been much more deeply damaged by the pandemic than the government sort of officially admits to. And that may explain why the ruble has not been following petrol prices so closely recently. Agricultural goods are also very closely influenced by petrol. If you look, for example, at the price of corn, it tends to follow the price of oil fairly closely. And sometimes corn prices, even especially in the last 10 years, have sometimes been a leading indicator of where oil prices are going in the future. So sometimes corn prices hit bottom before crude oil and begin to rally before crude oil does. There's also a relationship between wheat and crude oil. Corn is used in many countries, including the United States, as a source of ethanol. In Brazil, they use sugar, but in the United States, they use corn. Where wheat can also be used to create alcohol as well, most famously when we make beer, but it can also create alcohol as well, which can be used as a fuel blend. The price of soybeans also follows the price of crude oil quite well. But this is one of the weirdest things, I think, in the crude oil market. Is what I'll show you next, which is the relationship between soybean oil and crude oil. So soybean oil at times has been a leading indicator of crude oil. If you look, for example, back in 2006 and 2007, you can see that at this point in time, oil prices were having a strong rally. Soybean oil prices weren't going anywhere. So what happened? Well, crude oil prices corrected. Then soybean oil prices began soaring, and crude oil prices later on began following them higher. If you look at number 3 in 2008, soybean oil prices peaked before crude oil did. Soybean hit its peak in January 2008. The oil market peaked in July 2008. If you look at number 4, soybean oil prices hit bottom in December 2008. Crude oil hit bottom in February 2009, 2 months later. If you look at number 5, soybean oil peaked out before crude oil. Look at number 6, soybean oil, along with corn, by the way, began this tremendous decline in price before crude oil did. You look at number 7, soybean oil prices hit bottom before crude oil did. You look at number 8, they peaked before crude oil did. You look at number 9, soybean oil hit bottom before crude oil did and had this tremendous rally that has anticipated the rally that we've recently seen in crude oil. You might even add a little number 10. Soybean oil prices peaked out in May. Oil prices peaked out a couple weeks ago and then suffered a rather sharp correction so far this month. The vegetable oil markets, including soybean oil and also its cousin, palm oil, have been these phenomenal indicators of where crude oil is going. Palm oil also, I should add, works really, really well as a leading indicator of crude oil. So the question is why? Why does this happen? I think it happens because in 65 countries around the world, including many of the biggest places, Europe, the United States, Brazil, China, they have biofuel mandates that require that when we make gasoline or diesel fuel, that we mix some agricultural goods into those fuels, whether it's vegetable oil like palm oil or soybean oil, or whether it's ethanol from corn or from sugar, it gets mixed into the final fuel blend. And the thing is, the agricultural markets, even though they're very big, they're extremely small compared to crude oil. The size of the palm oil and soybean markets is about 5% or 4% the size of the crude oil market in terms of trading volume. So what I think happens is that when there is going to be a shortage of oil, the producers call up the farmers and say, could we have more soybean oil or could we have more palm oil in order to mix into our final fuel blends? And because the vegetable oil markets are very small compared to the crude oil market, they have a very strong price response that anticipates what's going to happen later on in the crude oil market. By contrast, when there is an excessive amount of oil, when there is too much oil, the energy producers basically say to the farmers, no thanks, we have all of the fuel supply we need right now. We don't want to take on any more fuel additives. And so the price of the agricultural commodities tends to fall before the price of crude oil begins to fall. So I think if you're going to trade in crude oil, I would look at palm oil and soybean oil as very, very interesting places to look. Now, there's one final point here, which is if you do look at palm oil, that's fine, but it is priced normally in Malaysian ringgits. So you should take the ringgits and convert them to dollars in order to measure the dollar price of palm oil rather than the Malaysian ringgit price of crude oil. Now, getting towards the end of the presentation here, we also have the relationship between oil and copper. Oil has a strong relationship to industrial metals. And part of the reason for that is that mining metals is extremely energy intensive. So to bring copper or gold or silver or platinum or palladium or aluminum or iron or any kind of metal out of the Earth's crust and then refining it requires a great deal of energy. And some of that energy does come from crude oil. Now, in the past 12 months or 15 months, copper prices have gone up very, very high versus crude oil. And that is because people have been able to spend money on manufactured goods and on home improvements, but they have not been able to travel. But of course, this situation will not last forever. As transportation rebounds, I think what is likely to happen is that crude oil prices will go a lot higher because they will go higher more quickly than the energy producers can increase production. OPEC recently did increase production that may have contributed to the recent correction in crude oil prices. But even so, if the pandemic goes away over the next 12 months and everybody begins traveling again, you could see a really strong increase in crude oil demand. Now, of course, there are counter arguments. One counter argument is we have all become accustomed to working from home. So this idea that everybody has to go to the office every day is now outdated. Almost no companies, I think, are going to force their staff back every single day. And also the idea of business travel is also seeming somewhat outdated as well. And environmentally irresponsible, especially given the terrible environmental or weather-related events, I should say, that we've had in the last year, like the flooding in Germany, the terrible flood overnight in Zhangzhou, China, that put an entire city underwater, the fires in the Western United States and Canada and in Siberia, droughts in South America and Africa and the Western United States. We're really starting to see more and more climate impacts. So the trend is to turn against crude oil and more towards lithium and cobalt and copper and solar energy, batteries, wind power, et cetera. One last indicator of demand, of course, is China. China has their official gross domestic product, which is fine. You can look at China's official GDP. There's nothing wrong with doing that. But I like an alternative measure better called the Li. Oh, sorry. I like a different measure better called the Li Ka-Cheng Index. Sorry, Siri heard me talking and some reason thought I was talking to Apple Siri, and that's what that voice was. It was my Apple
Don't
Watch
worry about
talking
it.
to me. Yes, if you're wondering why Siri suddenly spoke, it thought I was talking to Siri. But the Li Ka-Cheng Index is a great indicator of where commodities are going in general. It is composed of bank loans, electricity production, and rail freight volumes, and it has a pretty strong relationship with the price of crude oil. China's growth is starting to moderate on the industrial side. That may also be responsible for some of the correction we've seen recently in crude oil prices. But I think that along with vegetable oils, the Li Ka-Cheng Index is the other secret ingredient for navigating the oil market. It's available for free if you have a Bloomberg. Of course, isn't free. CLKQ index is the code there, but I think there are other ways you can find its price history through the news media. And so do we have anything else? Yeah, I would just briefly point out that China also has its own issues. They have tremendous increase in debt, but I think we talked about that last time. And they've also had a huge, huge rise in their currency, which is reducing their competitiveness. And that may also slow their growth going forward, which would not be good news, by the way, for oil prices. So on the one hand, you have the reopening, and that can be good for oil prices. You have the fact that production might not grow quickly. That's positive for oil prices. On the other hand, you have China potentially slowing down, which would be bad for oil. Inventory levels are still somewhat high, which might also not be good for crude oil prices. But lastly, look at what the vegetable oils are telling you. Palm oil, soybean oil sometimes say very interesting things about crude. So that's it for the slides that I prepared. I'd love to open it up to questions. I think we have maybe at least 15 minutes or 16 minutes or so to discuss.
Yeah, of course. Thank you for your presentation, Eric. It was really awesome about the correlations. And if you don't mind, I will start about that. So you refer that considering the crude oil, there is some other ways to see what is going on. And you refer that we could compare the prices of crude oil with palm oil, soybean, or even corn. But my question is, what would you consider would be from these three, for example, the best to try to understand what is going on with oil prices at a certain point?
Yeah, I think the best two are probably soybean oil and palm oil. They seem to work a little bit better than corn because essentially soybean has three different markets. So there's the soybean itself, then there's a soybean oil market, and there's a soybean meal market. So the thing is, same thing is true for palm oil. Although you don't really talk a lot about palm oil meal, but meal is basically the protein that comes out of soybeans. And so meal is mainly used as an animal feed. So it's used to feed, in particular, pigs and chickens. And so what's happening to the price of soybean meal or palm meal is not particularly interesting from the standpoint of crude oil. Likewise, corn also gets split into different uses. Some of it is used for ethanol, which is used as a fuel blend, but a lot of corn is just eaten. It can be eaten as animal feed, which is more the case in Europe, or in North America, particularly in the United States and Mexico and Canada, people eat a lot of corn. It's a major part of people's diets in North America in particular. So the corn market, we do have an ethanol future. I don't really follow it very closely because it doesn't trade in gigantic volumes. So I don't think it's as good an indicator as palm oil or soybean oil. But what I like about palm oil and soybean oil is that they are already in oil form. So they, in their current form, they can be refined and put into fuel blends. And so they tend to track the oil market a bit more closely than corn does.
Okay. About this, someone questioned us which one could indicate the way for crude oil. Which one should we follow to try to understand what crude oil could do next?
Okay, I think that you're best off if you follow a variety of indicators and don't rely too much on one indicator. None of these are perfect indicators. So I would look at soybean oil, palm oil, the Li Ka-Cheng index in China, and I would also look at the TSA data on the number of people flying in the United States. I think those four pieces of data provide you with a really strong, either real-time or, in the case of the Li Ka-Cheng index, almost real-time view of what's happening in the economy.
Okay, thank you. We have another question from one of the participants. The question is the correlation about alternative energy on crude or Brent in 5 to 10 years, if there is any correlation about it.
Yeah, it's hard to say a correlation. When you look at the prices of alternative energy, like if you look at the price of solar or wind energy, it's extremely volatile. The prices can move a tremendous amount during a single day. And it can also move a lot from one season to another. For the moment, I would put them in somewhat different categories. Crude oil is really mainly a transportation fuel, whereas alternative energies like solar and wind and batteries are basically an electrical energy. Now, of course, we know that there are more and more electric cars. Tesla, for example, its market value is enormous compared to the other automotive companies. There are more and more electric cars coming online. So the frontier between what is electrical and what is transportation will start moving against the combustion engine. And it is moving against the combustion engine, but it's a slow and progressive process. I don't think even in 5 or 10 years we will have fully converted the vehicle fleet. I think it will take longer than that. I think it'll take more like 20 or 30 years to completely get off of petrol. But let me tell you one thing to think about. When we do get off petrol, it will have one major unexpected consequence that nobody is talking about. If you look around you, like, I mean, let me see if I can put my camera on just for a second here, just so I can show you my immediate surroundings here. I'm not sure if my camera is working, but I'll just describe my immediate surroundings. So on my desk, I have a plastic water bottle. I have a mouse pad that's made out of petrol. I have a little rugby ball that's made out of petrol. I have a sort of spinning globe that's made out of petrol. Plastic is all around us. My telephone is made out of plastic. And so one of the unexpected consequences of getting off of petrol is that plastic is currently produced as a nearly free byproduct of petrol. I mean, it does cost money to buy plastic, but the cost is extremely low. When we start reducing the amount of petrol, suddenly the prices of plastics is going to soar. Now, we don't have plastics that trade on our exchange, but there is a Chinese exchange that does have a plastic price. And I think that's going to be really interesting to look at as we move off of oil. But this is a longer term issue. It's not going to change how you invest in 2021 or 2022.
Okay, thank you for that. Other participant is asking, how do you see the evaluation of crude oil for the next 3 to 4 months, considering the impact of the pandemic in the US, in other countries, and countries with large productions of crude oil, for instance, and on the demand too, because with everyone trying to work from home and on this time of the year, if this will affect negatively the price of crude oil for the immediate term.
Yeah, it's really hard to say. I think in the kind of near term, the crude oil market, it's going to be pretty challenged because for precisely those reasons. For one thing, the pandemic is not over. Even though we have very high vaccination rates in the United States and now in Western Europe, it's catching up with the US and the United Kingdom in terms of vaccination. Travel between countries is still very hard. People don't necessarily want to go back to the office full time, at least not most of them. And for much of the rest of the world, the pandemic is still very much a reality. Like in South America, for example, in Russia and India. And then you also have other countries like China and Australia that did a phenomenal job of preventing COVID from spreading initially. But now very few people there want the vaccine because they haven't seen many people die of it. They don't really think it's a problem. It makes it really difficult for them to open their borders again. And if they do open their borders and they start having to go back into lockdown. So we've seen China or parts of China and parts of Australia go back into lockdowns again in the recent period. So it's you also see problems in Japan now and in South Korea with COVID starting to spread. And much of the world is still very far behind on their vaccines. Like in Africa, for example, 1% of people have been vaccinated. In India, it's still less than 10%. So it's going to be a really long road out of the pandemic, I think. Eventually, I think COVID will become kind of like the flu. It'll just become something you live with, something that's manageable for people who've been vaccinated. But we're still a really long way from that point. And then, of course, as you rightly point out, there are permanent changes in behavior that will not go away after the pandemic ends. And so all of that will make it difficult for oil producers to ever boost their production back to where it was previously.
Okay, thank you, Eric. About this, and I don't know if I asked you this, but I will try anyway. But someone is questioning the better way to expose to crude oil about the CFDs or future trading. What is your opinion on this? I know you are a suspect because you are at CME, but
Yes,
I ask you
yeah.
anyway.
Well, look, I'm very biased. Like, I think that futures trading offers exceptionally low transaction costs compared to other ways of doing it. So I think that on a transaction cost basis, futures contracts are often more efficient. One of the arguments against them previously was that they tend to be of pretty large size. So for example, our main contract on crude oil is $75,000 face value. It's essentially a 1,000-barrel contract. So, if the price of oil is 70, then it's $70,000. And that can be a lot for a retail investor, especially if they don't want that much exposure to the crude oil market. But there are now mini or micro futures on crude oil that allow you to gain exposure in much smaller sizes. And those might be more practical, and I think would give you probably pretty good advantages in terms of cost versus other ways of gaining exposure.
Yeah, I could show you that because we have a new product since the 12th of this month. The micro of crude oil is a future, and for instance, the exposure could be only 100 barrels, and is a margin product. So you could not expose too much, like you have to on the bigger contracts, and the costs of exposure is really, really low at this point. For instance, I could try to just to give this just a moment. Could try to replicate, but for an exposure of 100 barrels, you will have about a cost of 4.5 US dollars plus tax, and you only need about in margin trading about $500 to expose. So yeah, it is a new product, and you could all use it also. I don't know if anyone has any other questions about. Okay, someone is questioning about the correlation of gold and crude oil, and if it is something to look at.
I think that sort of day-to-day correlation between gold and crude oil is pretty low. But there does seem to be this pattern, and we'll go back to the charts. There does seem to be this pattern, though. Sometimes when one price gets away from the other price, it winds up coming back in the end. So for example, if crude oil prices, say over a period of time, go up a lot more than gold, crude oil sometimes brutally corrects back to the level of gold. Or the same can be the opposite. Like if crude oil prices go under gold for a long time, eventually maybe they correct backwards. So over a really long period of time, kind of on average, 1 ounce of gold typically buys about 25 barrels of crude oil. And it happens to be coincidentally right now that we're pretty close to that average level. But it varies a lot. But I tend to think that there just tend to be really strong trends in those ratios. So once you see a trend developing, you may want to ride the trend for a while. And then when the trend starts to reverse, you get on it the other way. But I think it's a really interesting combination to look at, because I think not many people do look at it. Because not many people do look at it, there may be more opportunities there to make exceptional gains.
Okay, okay. Really thank you about this, Eric, about all your presentation. This completes one other webinar of our series, this one of crude oil essentially. But I remember you all that we will have another one next week, a practical one, this one in Portuguese and more in a trading perspective. We will seek to seize the guidelines done by Eric and the correlations about soybean, for example. But I ask you for all of you that are doing this series with us, if you don't have a platform to use, we recommend if you could use a demo of BiG Global Trade or BiG Power Trade, because on the next webinar we will go a little bit practical on some of these visions that thankfully Eric could give us about the insides of oil. And we will see the products that you could use about CFDs. We could talk about the newest product, the MCL, that start trading a few days. For just a curiosity, it was a strong start, about 270K on the first 7 days of trading, 270K number of contracts trading, and these have 1 to 10 the size of the normal crude oil contract. So we will see all these differences. I ask you all, if you don't have a platform to use, please download the demo on BiG so you could be with us and understand everything that we are trying off and showing off on this special webinar. So thank you again, Eric, for all of your presentation. Thank you all for being present and do another series with us. Any questions that you have, please tell us. Any comments that you want to leave, please let us on the chat line. We will see them, and any questions that you have, we will try to answer, of course, to all questions gave. Thank you once again to all, and a special thanks for you, Eric.
Thank you very much.
Thank you. Have a good day.
Thanks. Bye.